As is customary, we have more educational stuff for you today as we discuss smart money is purchasing Alibaba stock. Here is what we've learned thus far. To begin, consider why certain investors are interested in Alibaba. So, in this video, we will attempt to look over what a number of notable investors have stated publicly to see what they think about the benefits and drawbacks of Alibaba. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my best greetings. Hit the like button, subscribe, and click the notification bell next to it on our Smart Stocks Academy channel to be the first to know when a new video like this is released. If you're ready, let's get to the video as soon as possible. Let us begin discussing China. Most of us look at Alibaba and agree that the stock appears to be cheap for the underlying company. But the reason it's so cheap is that many investors are concerned about China's future and whether Alibaba will be able to prosper there. Beijing's expanding crackdown on private businesses has pounded the Chinese internet retail titan in recent months, raising questions about its survival. Despite a rise in sales, the company's profitability has decreased. The company's net income fell to 45.1 billion yuan and $7 billion from 47.6 billion yuan a year ago, although adjusted profits were somewhat higher than analysts' recently decreased projections. While Alibaba's revenue of 205.7 billion yuan, which is about $32 billion, was up 34% year-on-year, it fell short of forecasts. You can see why investors were concerned. The corporation attempted to reassure investors by saying that it will repurchase $15 billion in shares until next year, up from a previous plan of $10 billion. It is also revealed that it has repurchased $3.7 billion worth of its publicly listed shares in the United States since April. Is this going to make things any better? Well, as an Alibaba stock investor, would you feel secure? Perhaps it does. Well, it all depends on your perspective on the circumstances. However, how did we end ourselves here? We know that Alibaba's core business, e-commerce, performed well during the coronavirus outbreak, with sales surging as consumers turned to online shopping to purchase without leaving their homes. The corporation has also profited from China's ongoing economic growth, which helped the country avoid the global slump that hit much of the world last year. So how did the firm fare? And what is the reason for the decrease in earnings? We believe it is because the threat of more Chinese regulator monitoring looms big. Let us take a deeper look at what is going on there. In May, Alibaba announced a $1.2 billion loss for the first quarter, owing mostly to a record $2.8 billion punishment levied by Beijing after the business was accused of operating like a monopoly. That was a heavy penalty. So, we've looked at the Chinese government's crackdown, but does it end there? Beijing's larger crackdown has continued unabated. Alibaba's New York listed shares fell roughly 14% in July as investors became concerned about Chinese technology, especially the capacity of such businesses to trade outside China. We can see why investors are concerned, given everything that has been going on. We believe that the majority of China would be off limits to certain investors simply because they would not be able to comprehend it. Consider a company like Tencent or Alibaba. These two firms, in particular, have Western or non-Chinese investors from the very beginning of their journeys. We conceive of them as being located in China and having access to such a vast market. They also happen to have the majority of their activities in China, but they're truly worldwide in their outlook and how they look at things in many respects. We'd say they'd had a lot of non-Chinese infusion into their DNA and thinking, and many of those parts are huge pluses for them. But we still have a lot to say about investors being concerned about Alibaba stock. What else do we have? Well, investors have been scared by regulatory scrutiny of a growing range of businesses. Several famous Chinese IT businesses, including Alibaba, have lost hundreds of billions of dollars in market value due to a stock market sell-off. Beijing released directions for education technology, food delivery, and other industries at the same time. And we believe that investors must maintain their composure in order to overcome the scenario. When it comes to investing, we all know that panic is a lethal disease. Yes, we do recognize that the firm is dealing with major challenges, but it is also a company with significant potential. Its marketplaces are used by approximately 1 billion people worldwide, including 891 million in China and 240 million in other countries. The increase in organic sales is 32%. It's only getting started with its Ali Cloud, a cloud computing service that might be the next big thing. Perhaps, as an investor, you should take it easy and wait for Alibaba stock to climb and dominate once more. We believe Alibaba is a fundamentally sound company, as its primarily operational areas continue to expand at exceptional rates. Despite its rapid expansion, Alibaba stock trades at less than 3 times projected sales, making it a good long-term investment. Alibaba's $15.5 billion in donations to China's shared prosperity projects has investors worried. It raises questions about the company's subservience to the Chinese government, as well as the government's influence. Investors, on the other hand, appear to be overlooking how the firm is slaying 2 birds with 1 stone. There is a lot more to this story than meets the eye. So far, we've discussed Alibaba's lows. Now it's time to reach new heights. Here's what we've learned thus far. With its contribution, the aim is that it will be subjected to less government inspection and will be safeguarded from Western competition. The judicious allocation of finances may also earn the Chinese people a lot of goodwill. Perhaps more crucially, because the donation concentrates on the implementation of digital services in disadvantaged areas, it is expected to grow its client base. Moreover, Alibaba has been investing in its core companies in order to boost sales from current customers. Greater consumer involvement, increased purchase frequency, and unique value propositions are all goals. What are your thoughts on this strategy? In my opinion, it is the wisest thing Alibaba could have done in the face of intensive federal scrutiny. Despite this, the company's foundations have remained quite solid. Alibaba has seen a number of setbacks in the last year, but his main companies have continued to perform well. Its sales increased by 41% to $109.5 million in fiscal 2021, and its adjusted net income, excluding the antitrust charge, increased by 30% to $26.3 billion. Sales from core commerce climbed by 42%, while cloud computing revenues increased by 50%. Alibaba's revenue is expected to increase by 29% this year, according to experts. On the other hand, analysts predict that the adjusted EPS will fall by 26% this year, as corporations depend more heavily on lower margin retail industries and undertake much new expenditures. Analysts predict revenues and adjusted EPS to increase by 21% and 15% respectively next year. Using these figures, Alibaba stock still trades at less than 3 times projected sales. So much for a corporation that many investors felt was on its way to losing money. With its outstanding performance, the corporation continues to prove investors wrong. Don't you agree? Are you aware that Alibaba's domestic retail division still accounts for over 65% of the company's overall sales? However, its non-core industries, such as international retail logistics and cloud computing sales, are growing at a rapid pace, indicating that there is plenty of space for the company to develop even more. The stock of Alibaba has taken a battering in the last year as a result of regulatory issues, but it is a fundamentally sound company that continues to outperform in all of its sectors. Furthermore, its recent developments will lower regulatory concerns and improve its overall addressable market in the future, making the stock a top e-commerce pick. The decision to hold the Alibaba shares is entirely yours. After a lengthy period of underperformance, Alibaba's relative strength line is beginning to trend upward. We feel that the Chinese stock market will see brighter days ahead, and we will keep you informed. And with that, today's video comes to an end. If you haven't already, hit the like button below to show your love and support for this video. Don't forget to subscribe to the channel by clicking the subscribe button below. Also, turn on the notification bell next to it to be the first to know when a new video is posted. Thank you for stopping by to watch, and we hope you had a great time. We hope to see you again.